Hey everybody, welcome to Two Guys Talking Houses. We're the two guys. I'm Stephen Barnhill, licensed real estate agent in Texas, and this is Marc Elliot, loan officer with NRL Mortgage. Today we're going to get into topics related to the federal funds rate and some of the changes and the cuts that happened back in September and how that has not exactly shifted mortgages in the way that some of us thought. So Marc, let's get right into it. So mortgage rates hit their low of a couple of years at about 5.75 in anticipation of this federal funds rate being cut by either a quarter of a point or half a point. Turns out on September 18th they actually did lower a half a point, and so we all thought, us agents at least, maybe you LOs had some insight that we didn't necessarily know about, but we thought, okay, the Fed is cutting rates. That means mortgage rates are going to follow. And then fast forward to today, we're now in mid-October and rates, as you just told me, are sitting at 6.68. So I guess the best place to start is to ask you, what the heck happened? I thought that when the federal funds cuts rates, that the mortgage rates follow.
So it's been interesting. So and it kind of goes back to the July meeting. End of July, the Federal Reserve said, "Hey, we're not going to cut rates at all. We're going to leave them right where they are." And that triggered everyone to think, you know what, they're going to have to cut in September.
Right.
So, which is what caused rates to go down after that July meeting. And that's how we got to 5.75. So while everybody's waiting for the September meeting, mortgage rates have already gone down. Just nobody was really paying attention to that, know, because general public doesn't believe anything till they read it on Facebook or see it on Instagram or TikTok, right?
Yep.
So, and so everybody's anticipating this meeting in September. Well, it was already priced in, you know. So, so the 18th comes along, and it's sure enough they cut a half a point off the federal funds rate, and that in theory would have helped, but then it was followed by some jobs numbers. It was followed by Chairman Powell getting up there and talking, which often affects the market.
Yeah.
When Chairman Powell or any of his governors, presidents around the country talk, it can have a dramatic effect on the market.
Yeah.
There was one day Powell came out and said, we're in no hurry to lower the federal funds rate. Well, that did not help us.
Right. Sure.
Everybody else is saying, oh no, it's going to be a quarter point at the next meeting in November, and then it's going to be one more cut at the end of the year. We're going to have 25 basis point cuts.
Right. So so it looks like, if everything holds true to what they're saying, we're going to have a cut of a full point by the end of 2024.
Correct.
And what's really interesting to me is how much these rates can actually, the anticipation rather of the rate cuts can be baked into today's price. So we saw that after the July meeting, as you said, Chairman Powell came out and said, we're not cutting rates in July, we're holding tight, which gave everybody sort of the inclination that we're going to be lowering at some point this year. We have to, otherwise we're going to cause a recession. The job reports are not going to be great.
Yeah.
So in anticipation of that September cut, the rates already came down. And so what the drop that everybody was waiting for, they almost didn't realize that it happened because they had their eyes on September 18th, and then mortgage rates are just steadily declining. And then boom, the meeting comes. And as you said, sometimes when Chairman Powell starts talking, mortgage rates start going up. It's a funny thing. But, what are some of you mentioned the jobs reports, and what are we looking for when we talk about jobs reports? Like, what would be a jobs report that would cause mortgage rates to potentially fall? And what would be the results of a jobs report that could potentially cause them to climb higher?
Well, and maybe we should take a minute and address one thing, which is, what is the federal funds rate?
Right. Yeah, that's a great question.
And so, the federal funds rate is the rate that banks lend money to each other to meet their liquidity requirements. So if you're a bank and you had a bunch of loans that day, the federal government says you have to have this much in your reserves, in deposits, in your bank to make those loans, otherwise you're out of compliance.
Right.
So they lend money to each other to meet those requirements overnight. And that's what the federal funds rate, it's a target rate. They are going to, target that rate as the cost of funds when you borrow money overnight. Well, that translates into the loan rates, credit card rates, car loan rates,
Right.
things like that. And that's what we're truly talking about. Mortgage-backed securities are an investment, which is not tied to that, but it
Right.
does generally follow that.
Gotcha.
So yeah, exactly. So, we should get that out of the way just because people don't always understand.
No, and it's a great point to make, because a lot of people think that when Jerome Powell's cutting rates, he's actually cutting mortgage rates, and he's
Yes.
not. It's the federal funds rate is the rate, as you said, in which banks borrow from each other to stay in compliance. So it makes sense that, if banks are having to borrow from each other at higher interest rates, that you're not just your mortgage, but your credit card payments, your interest on that, your car loan interests are probably going to go up, because the banks at the end of the day are for-profit businesses. They have to make money, and if they're borrowing at a higher amount, they're going to have to loan it out at a higher amount. So it really is, it's a complex machine, but if you break it down, it's really not all that difficult to understand, I would say.
Yeah, the basic concept, if I lend you $100,
Yeah.
I got to go get that $100 somewhere. So it costs me $105 to get that $100. I got to charge you $110 to make it worth my while, right? So, and that's what's going on, is if it's costing $106 or $108 or whatever, because the federal funds rate is up, then I've got to charge the consumer on my consumer loans, on my commercial loans, to develop business, to buy more machinery, to hire more people, the things that businesses get loans for, that drive the economy. So back to the jobs thing.
Yeah.
So yeah, because I don't want to, that is certainly relevant. There's kind of a dual mandate with the Federal Reserve. They've got to keep inflation at 2% or less. That's their goal.
Yeah.
Or at least be heading in that direction. So anything that looks like we're not heading in that direction is bad.
Right.
Right. And so, but the second thing is we got to keep this economy out of a recession.
Sure.
And so, recession is when the growth, GDP, gross domestic product, shrinks, right? And so we don't want that. So it's this kind of delicate balance. Well, we had a jobs report recently we missed by, 130 something thousand jobs.
Wow.
And it was, it's the jobs that were created that week were 130,000 more jobs than we thought.
Okay. So that when you say missed by 130,000, that's what you mean is, like, let's say the target was 300,000 and we ended up with 430 new jobs. That's missing, quote unquote, by, and that would seem like it's a good thing for the economy, right? Like if more people are getting jobs, but I guess that also doesn't create the urgency to need to cut those rates to avoid the recession. Do I have that right?
Well, and really it ties back to inflation. If you got people who are not, who are losing their job, or they're uncertain if their future, they're not out there spending money. And there's dozens and dozens of indexes and economic numbers that come out every week.
Sure.
So it might be, today is, building starts, permits, things like that show, okay, the economy's growing because we're building houses.
Right.
And unemployment numbers, when they come out, or employment numbers, depending, it's based on jobless claims or ADP's payroll numbers, how many people, because they handle a lot of payroll for the country, right? So, those numbers can have an effect, and all it's indicating is like, oh my gosh, the economy is actually stronger. We need to slow it down,
right,
to keep inflation under control.
Gotcha.
And so, when we have a miss, what that means is that the investors, the community, thought it was going to do one thing, and they come up with a number a few days before the index comes out, and then it misses.
Right.
It's not that number. It's higher, it's lower. Or, maybe the Bureau of Labor Statistics figures out they missed 800,000 jobs.
Which did happen, right? Yeah.
Which did happen, and then so it calls into question, like, okay, the Bureau of Labor Statistics is saying, well, it's $130,000 better than we thought it is.
Right.
Well, okay, wait a minute. If more people are employed, inflation takes over, retail sales, things like that.
Sure.
So, and there is kind of wild card in there with the election.
Yeah, and as we've seen, you brought up a statistic in one of the presentations you gave to our real estate team that there are some things that happen before elections typically, but generally after elections, regardless of which party wins, things do tend to normalize. Do I have that right? Or
Yeah, I mean, well, and it's kind of a general feeling of people, business people right now, I have a friend who owns an IT company. I asked him the other day, how are things going? Well, we're kind of on hold. Well, why is that? Well, nobody wants to spend money to upgrade their network. Nobody wants to do projects around their business that need to be done right now before an election until they know what's going to happen.
Right.
And no matter where you are politically, if one or the other gets elected, it's going to do something.
Right. And I've got clients that are both waiting. I have two separate clients, both waiting until the results of the election are made clear. And both clients are hoping for different outcomes, right? So it's like, I don't know exactly what you all are waiting for, but there's a specific thing that you want to see, after the election to make your final decision as to whether right now is a good time to buy a house or it should be at some point down the road. So those things do factor in. Now, we were talking about future cuts, and you said that we're probably going to cut a full point this year. I think the statistic that you showed me is that 86.4, if I have that right, percent of the people that I guess make up the vote within the Fed think that we're going to, you correct me if I'm wrong, are going to think that we're going to cut by 25 or 0.25 points this next meeting.
Something like that. And what that is, it's the Chicago Mercantile Exchange. Okay. And they monitor statistics and reports and numbers from everywhere. Right. And so it's not the Fed presidents or the governors that are, they're polling. They're actually just looking at the whole market and going like, okay, 86% chance we'll cut a quarter this time. Okay. And now if jobs numbers come out, like we did have a big miss on some job numbers, some retail sales, things like that. And, because if people are out buying stuff, then retail sales numbers are up and then inflation follows. Right. Sure. So, but they're saying, hey, it's 86%. Well, maybe if we have a job report miss or retail sales or building permits or something like that, that could affect that 86%. Maybe now it's 82%. Right. Sure. And it's all about like, what do we think is going to happen? Now, you mentioned the best time to buy a house. Yeah. The best time to buy a house was 20 years ago. That's right. Yeah. The second best time is right now. And seriously right now, because, if you think about it, if you go to under contract right now, we just passed the last day to put in a contract and start your loan to close in October. Right. Usually it's about halfway through the month. We can get a loan closed in 15 days if needed, so we have a last day cutoff. Well, so you're closing in November, and guess what? You're closing after November 6th at this point. Right, yeah. So it's going to be after the election that you're closing. So if rates make a drastic change because of that, then you have time to react to that, lock your loan or relock your loan or whatever the case may be. Yeah. Yeah, and the other thing that we talked about too is the amount of buyers that are going to be coming into the market as the rates drop. And that's something that as an agent I'm advising a lot of my clients on because we're seeing houses that are sitting on the market 1, 2, 3 months, and we're able to negotiate some seller credits to the buyer. We're able to negotiate a lower sales price, and I'm doing that on a pretty consistent basis. But I'm always very wary to advise my clients, hey, if these rates start coming back down, because a lot of clients are like, I want that 4%. I want to wait till it's 4.5%, 5%, and I almost want to tell them, and I do tell them, be careful what you wish for, because remember back in 2021, if you knew anybody that bought a house back then, I don't think rates are going to go back to 2.5%, 3% anytime soon. But when they're in that 4.5% to 5.5% range, we're going to have several million new buyers flood the market. And that house that was listed for $400,000 that I got for $385 for you, and I got you a few $1,000 in seller credits towards your closing, that deal's not going to be on the table anymore. So you do have to find that delicate balance of what interest rate are you comfortable moving forward with versus how competitive do you want to be with other buyers in the market? Because right now, I see it as, I don't know if you're kind of experiencing the same thing, but it seems to be about even. There's the buyers, the sellers, homes are sitting on the market about 30 days. If they're priced well, they're getting an offer or two. And so it's a reasonable market. Whereas, a few years ago, it was somebody puts their house on the market for $300,000 and all of a sudden you have 6 cash offers for $325,000 and better. And people are literally fighting each other to get a house. So I think
that's kind of my follow-up question to that. If these two rate cuts do happen of a quarter point each before the end of the year, not asking you to pull out your crystal ball that you've got over there, but where could we see mortgage rates come the end of 2024 if we do get that full point cut in the federal funds rate this calendar year?
And now's a good time to say I'm not an economist.
Yeah.
I did not sleep at a Holiday Inn Express last night. But I've been doing this, a long time. Yeah. And so, we can kind of look at, okay, if the federal funds rate comes down like it's supposed to, how much are rates going to come down? Well, it's based on so many other factors, unfortunately, that it's tough to say. But yeah, I mean, we think it'll, end up six and a quarter maybe by the end of the year. I hate to throw out numbers and then, make a false prediction. Yeah. And we always say, like, they repossessed all the crystal balls in our business back in the 2008 mortgage meltdown. Yeah. So, like, we don't 100%, nobody 100% knows, right?
Sure.
I was just watching, some YouTube videos because I'm not good at this myself. So I thought I'll copy others. And I saw one of our loan officers, I won't name her name, did a YouTube video like a year ago. And it was saying that at the end of 2024, we would be in 5.5% or something like that. Here we are at the end of 2024, and we're not. Yeah. And probably not going to be,
Probably not.
Yeah. So, and you touched on something, too, that is important, which is, the mortgage-backed securities market is what controls rates. It's all about how attractive is that investment versus going in the stock market or maybe buying a different investment vehicle like a bond. Mortgage-backed securities, typically they expect 5 to 7 years worth of interest out of it before somebody, sells their house, refinances, whatever they do, right? So it's fairly secure, it's fairly stable, you know what you're getting.
Right.
Right? As opposed to the stock market, I mean, who knows?
Sure.
There's educated gambling, we'll call it, in the stock market.
Right.
And so, if the stock market's doing well and mortgage-backed securities then have to raise the yield to attract investors.
Right.
Maybe the higher yield coupons start selling better, and then therefore rates they've got to go up as well. So what happened in the pandemic is the government was buying like $80 billion worth of mortgage-backed securities every month.
Wow.
And so what that did is it created, a false sense of supply. There wasn't as much, demand for well, I should back up. It created demand because the government's buying them.
Right.
But when you stop doing that, then you have to start looking at the higher coupons, the higher yields.
Right, sure.
To attract normal investors that are not the Federal Reserve.
Right.
And because the Federal Reserve's doing that to spur on the economy, which that's great. That's why we had 3% rates. That's why we had 2% rates. It didn't matter, those low coupon, notes, those mortgage-backed securities are selling left and right because the government is buying them.
Right, exactly. Yeah.
So,
and in a lot of ways, it was an unsustainable and unhealthy way to do things. I mean, I know a lot of people that have 2.5% mortgage rates, and good for them. I wish I had one. I bought a little bit after that. I'm in the 4s, but still, I'm quite happy with that. But the reality is, you do have to consider all factors when you're buying a home, and if you're overpaying for a home and you're waiving option periods, you're waiving inspections, you're doing everything you can and bending over backwards just at the chance that the seller will accept your offer amongst the half dozen that they've got, sometimes a little bit higher rate and a better deal in a more controlled market environment is a better situation for you when you consider all factors. Because it's easy to say, well, I got a 2.5% rate and your buddy's got a 5. Well, maybe your buddy got a better deal on his house than you did. So that's another thing that you have to consider, I believe.
Yeah. I mean, and during that time, we saw so many houses, just like you described, listed for 300, sells for 340.
Yeah.
And that's just because of the demand, right? Everybody and his brother wanted to buy a house. And you think of what was going on. During the pandemic, a lot of people were working from home, remotely, which puts them in close contact with everybody else in their home.
Right.
Well, now we need a bigger house.
Exactly.
Because you know what? I like my family, but I don't like them that much.
Right. Yeah.
I don't want to be that close to them all the time. So I want a house with a pool, or I want a house with a bigger backyard, or I want, whatever it is. And people did that during that time.
Yeah. And so my brother-in-law is in boat and yacht sales. and they had their biggest boom that they've ever had in the company's existence because it's like, okay, we can't go into restaurants, we can't go in public, you know, we need to get a bigger house because we love our family, but as you said, living on top of each other is not good for anybody, anybody's sanity in the house. And, you know, what can we do recreationally? Well, if we have a boat, we can go isolate ourselves and have a ball and be compliant, or whatever compliant meant back in those days. And yes, so, you know, people were overpaying for a lot of homes. And I'm sure you saw, you know, appraisals being an issue back then, you know, with somebody saying, hey, the home is 300 and I'm willing to pay 350, you know, sight unseen. I'm going to sell my house in California, and well, I guess not in a cash situation, you wouldn't be involved, but
typically not.
You know, somebody getting a loan, you know, were you seeing a lot of issues with appraisals back then?
You know, in the beginning, sure. But I mean, appraisals are all about comparable sales within close proximity to the house selling.
Right.
So, you know, if your house sells for $340,000 and it's the first one, yeah, you're going to have an appraisal issue.
Right.
But people were willing to pay the difference. You know, if it appraised at 320, and okay, great, let me pull out of my 401k, put down $20,000 more, and I have the house.
Right.
You know, but then after some time, you know, now, I mean, not only did your house sell for 340, but the house down the street did, and the house around the corner, and so now you have the comparable sales. So it's a short-term problem.
Sure.
You know, and so it wasn't an issue after a while, you know, because we had the comparable sales to support it.
Well, I think, Mark, that's a perfect place to leave it for today. Guys, thank you so much for watching this video. This is our first ever one of these that we're doing, Two Guys Talking Houses. Let us know in the comments what you liked about the video, what you learned, some things that you could suggest that we could change. We want to bring valuable content to you from the perspective of a licensed Texas realtor and a licensed Texas loan officer. Of course, if you're in the Houston area, we'd love to work with you. Reach out to us. We'll put the links in the description here. There should be a little QR code on the banner to how you can get in touch with Mark or I. And if you're anywhere else in the country, we do have a very strong referral network. So reach out to us and we'll set you up with somebody great. Until next time, have a great day. You have anything to say, Mark?
You know, I might add that, you know, a lot of people are afraid to talk to a real estate agent or a mortgage guy because that means you're buying a house.
Yeah.
Well, not necessarily. I mean, maybe we're just having a conversation and talking about what that looks like, and if it's a good idea or if it's not in your particular situation.
Right.
You know, I've had people take 10 years from that initial conversation to buy a house. They paid a whole lot more for that house 10 years later, right? But you know, that's the idea, is like, hey, we're here to help, to educate. They're making the decision, right?
Sure.
And so anyway, but that was the only thing I might add, is we're happy to do that. You know, reach out and just have that conversation, you know, and see if it makes sense.
Yep. God willing, Mark and I will both be doing the same thing 10 years from now. So, you know, reach out to us if we can help you now. Great. If it's down the road, that's great too. See you next time.
See you next time.